Good morning and welcome to the Morning Bell. I'm Robert, joined by Lizzie and Steve. It's Tuesday, February the 24th, 2026, and we have a lot to cover today. Lizzie, what are the main themes you're seeing in today's news?
Thanks, Robert. Well, the dominant story continues to be the Supreme Court ruling that's thrown the Trump administration's tariff strategy into flux. This is creating real uncertainty for global trade and the US economy. And we're seeing that anxiety reflected across markets. Jamie Dimon came out yesterday expressing high anxiety over lofty asset prices, warning investors to watch out as these elevated valuations add to economic risks. He specifically mentioned the potential for higher unemployment that the Fed might not be able to offset, which is a pretty sobering assessment from one of the most influential voices in finance. On the international front, China has slammed dozens of Japanese companies with export curbs, escalating trade tensions beyond just the US relationship. Meanwhile, we're seeing some interesting divergence in sector performance. Old economy stocks are actually looking pretty attractive right now, compared to some of the more speculative tech plays. Home Depot managed to beat Wall Street's expectations even as sales declined, which shows there's still some resilience in consumer spending. Though it's selective, the AI narrative continues to evolve, with Intel partnering with AI chip startup Sanbonova after acquisition talks reportedly failed, and there's growing discussion about whether we're seeing an AI bust even as the broader AI boom continues.
That's quite a mixed picture. The tariff uncertainty combined with Dimon's warnings about asset prices seems particularly concerning. What does this mean for traders trying to navigate these cross-currents?
The key takeaway for traders is that we're in a regime where selectivity really matters. The Supreme Court ruling on tariffs means we could see sudden policy shifts that impact different sectors very differently. Companies with significant international exposure or complex supply chains face heightened uncertainty, while domestic-focused businesses might actually benefit from reduced competition. The fact that old economy stocks are outperforming suggests investors are rotating toward quality and stability, rather than chasing growth at any price. For active traders, this environment favours a more defensive posture with tight risk management. Look for companies with pricing power, strong balance sheets, and less dependence on global supply chains. The Home Depot result is instructive because it shows that even with declining sales, a well-managed company can still deliver on earnings through operational efficiency. On the flip side, the AI sector is showing signs of bifurcation where the winners will continue winning, but the speculative plays are getting hammered. The Intel-Sanbonova partnership highlights how even established players are scrambling to secure AI capabilities, which creates both opportunities and risks depending on execution.
That selectivity is going to be key. Steve, let's get into the economic numbers. What's the picture looking like this week?
Thanks, Robert. Looking at what we've seen earlier this week, we got factory orders data released Monday, February 23rd. That report came in at 0.7%, which actually beat the forecast of 0.5% and was down from the previous reading of 2.7%. So we're seeing some moderation in factory activity, but still positive growth, and the beat versus expectations suggests manufacturing isn't falling off a cliff despite some of the concerns we've been hearing. Now today on Tuesday, February 24th, we don't have any major economic indicators scheduled for release, which gives markets a bit of breathing room to digest the recent data and news flow. Looking ahead to the rest of this week, we've got two important releases coming. Thursday, February 26th, we'll get initial jobless claims with a forecast of 216K compared to the previous reading of 206K. That's an increase of about 10,000 claims, so we'll be watching to see if labor market softness is starting to show up. Then on Friday, February 27th, we have the Producer Price Index, which is a high volatility indicator. The PPI forecast is 0.3% versus the previous reading of 0.5%. This is particularly important given all the inflation concerns and the Fed's positioning, so a hotter than expected reading could really move markets, especially with the tariff uncertainty adding potential upward pressure on input costs.
Those jobless claims will be interesting given Dimon's comments about unemployment risks. Lizzie, let's shift to our stock of the day. We're looking at Abercrombie and Fitch. What's the story there?
Abercrombie and Fitch is presenting a really interesting value opportunity right now, Robert. The stock is trading at $92.61, and it's been absolutely hammered this year, down 25% year to date and down about 9% over the past year. The stock hit a 52-week high of $133 back when sentiment was much more optimistic, but it's pulled back significantly and is now trading closer to the 52-week low of $65.40. Here's what makes this interesting, though. The company operates a portfolio of brands, including Abercrombie, Abercrombie Kids, Hollister, and Gilly Hicks, giving them diversification across different demographics and price points. They've built out a solid omnichannel strategy, combining physical stores with e-commerce, which is critical in today's retail environment. Now, looking at the valuation, This is where it gets compelling. The stock is trading at a PE ratio of just 8.91, which is dramatically below the typical retail sector average of 15 to 20 times earnings. The forward PE is 8.79, so the market isn't expecting much earnings growth. But that low bar could actually work in favour of the stock. The price-to-book ratio of 3.22 is reasonable for a company with valuable brand equity. The company has earnings coming up on March 4th, with consensus expecting EPS of $3.56, which is down just 0.28% year over year, and revenue of $1.67 billion. The fact that earnings are essentially flat despite a challenging consumer environment shows operational resilience.
So we've got a significant valuation discount, but also real concerns about the consumer. What's the analyst community saying, and is this actually a buying opportunity or a value trap?
The analyst community is actually quite bullish here, which is notable given the stock's performance. We've got 9 analysts with a buy rating and an average price target of 123.44, which represents 33% upside from current levels. The extended coverage of 14 analysts has an average target of 117.36, still representing about 27% upside. What's particularly encouraging is that the average price target recently increased by 10% from the previous one, 06.54, so analysts are getting more constructive even as the stock has sold off. The price target range goes from $90 on the low end to $160 on the high end. So even the most bearish analyst sees limited downside of less than 3% from here, while the bull case offers 73% upside. Now, whether this is a buy, the dip opportunity really depends on your time horizon and risk tolerance. The bull case is straightforward. You're getting a multi-brand retailer with omni-channel capabilities trading at a single-digit PE multiple, with analysts expecting a recovery to 117 to 123 by year-end. The risks are equally clear. Consumer discretionary spending could weaken further, competition from fast fashion and online retailers remains intense, and the company pays no dividend, so you're purely playing for capital appreciation. My take is that this is a value opportunity for investors with a 6 to 12-month time horizon who can handle volatility. The March 4th earnings call is critical. If management can show they're maintaining margins and market share despite the tough environment, that could be the catalyst for a re-rating. But if we see guidance cuts or margin pressure, the stock could test that $90 support level. I'd wait to see how the stock trades into earnings before establishing a full position.
That's a balanced assessment. The risk-reward does look interesting at these levels. Let's move to crypto. Lizzie, what are you seeing in the digital asset space?
The crypto market is in a pretty bearish phase right now, Robert. Bitcoin has entered what analysts are calling full capitulation, dropping below $63,000, and there are mounting concerns that we could see more downside ahead. The critical 200-week exponential moving average has broken for the first time in over 2 years, and we're seeing a death cross formation on the 3-day chart, which are both significant technical warning signs. Some analysts are eyeing a potential drop to 60,000 or even lower in the near term. The sentiment has shifted to extreme fear, and while we haven't seen full-blown capitulation yet, according to some measures, we're definitely in a risk-off environment. What's interesting is the debate around Bitcoin ETFs. Some investors view the recent sell-off as a purification of the bull case, arguing that weak hands are being shaken out. There's also discussion about whether ETFs are quietly accumulating or just not selling, and the flow data is becoming increasingly important to watch. On the positive side, some analysts think Bitcoin could reverse course and rally to 75,000 if we get a short squeeze, particularly given the negative funding rates we're seeing. Looking at Ethereum, the picture is similarly challenging. ETH has extended losses alongside other altcoins as the AI scare trade has unsettled risk markets. The Ethereum Foundation just announced they're staking 70,000 ETH from their treasury to fund future development, which is a long-term positive, but in the near term we're seeing bearish chart structures that could target new yearly lows. Vitalik Buterin has sold over 10,000 ETH in recent weeks, which has added to selling pressure, even though he's stated it's to fund open source projects. Solana is facing its own challenges, with 3 platforms shuttering following a $40 million hack, which is obviously a major setback for the ecosystem. However, the Solana company is working on building high-speed infrastructure to prepare for the next potential supercycle, and we're seeing expansion of staking infrastructure in the Asia-Pacific region.
So across the board, we're looking at a bearish near-term setup. What should crypto investors be watching for next week?
For next week, the key factors to watch are the broader macroeconomic environment, particularly how the tariff situation develops, since that's affecting risk appetite across all asset classes. For Bitcoin specifically, the $60,000 level is critical support. If we break below that convincingly, we could see accelerated selling. On the flip side, if we hold above 63,000 and start seeing positive ETF flows, that could signal the worst is over. The institutional versus retail dynamic is important here. Institutional investors through ETFs have been relatively stable, while retail seems to be capitulating, which historically has marked good entry points for patient investors. For Ethereum, Watch the $2,000 level as key support and monitor any updates from the Ethereum Foundation about their staking program and development funding. The fact that they're putting treasury funds to work is actually bullish long term, even if the short-term price action is weak. For Solana, the focus is on security and whether the ecosystem can recover confidence after the $40 million hack. The infrastructure build-out is promising, but execution will be key. Overall, my view is that we're in a consolidation and reset phase. The next week could see continued weakness, but for investors with longer time horizons, these pullbacks are creating better entry points than we've seen in months. Just be prepared for volatility and don't use leverage in this environment.
Well, Balsam, that's a comprehensive look at the markets today. From tariff uncertainty and elevated asset prices to value opportunities in retail and a crypto market in reset mode, there's certainly no shortage of things to monitor. Remember, do your own research and consult with financial advisors before making investment decisions. If you found today's discussion valuable, please subscribe to The Morning Bell so you never miss an episode. I'm Robert. Thanks for listening, and we'll see you tomorrow.